This is Alex Barnes with Cornerstone Wealth Group. Thank you for joining us again today. We're shifting gears. Obviously, the last month and a half, the news and our webinars have been focused solely, almost solely on the markets, the election that we just went through, and then the reaction of the markets here towards the end of the year and planning for 2021. As we shift gears, though, one thing we wanted to talk about, and we're going to do a webinar series on, but we're going to start today talking about the basics of life insurance. So we're going to be talking about the fundamentals, types of policies, how they're used, how you can structure them. And joining us today, we have Sam Rocke and Ash Brokerage and Gina Schaefer, who are great partners of Cornerstone Wealth. So Cornerstone Wealth is most everybody in this call is going to be familiar with. And if there's any guests that are joining us today, we are a full service financial planning firm, fully independent. And the good thing about working with Ash Brokerage is that they're an independent insurance agency. And having them be an asset to us is really important because we're able to figure out products that fit our clients' needs, not sell our clients on something that maybe they don't need. So Sam, if you want to go ahead and switch us over here to the next slide, just so everybody has our information, we'll go ahead and kind of get that shown up here. So again, Sam, as the Senior Vice President of Marketing with Ash Brokerage, he's going to really be leading us today as we kind of discuss types of policies, again, how they can be used, individual aspects, business-related aspects. And from here, if anybody has any questions, please use the chat or the Q&A function. If you're joining us, we will definitely make sure to answer those questions today. I know that life insurance and insurance as a whole is a topic that maybe you know a little bit about. Almost everybody has it, especially if you're still working, but maybe you don't know how it's used or the best way to structure it. All right, so Sam, I'm going to go ahead and turn it over to you, and then I'll hop in as things applied from a planning perspective on our end.
Yeah, great. Thanks, Alex. And thank you to everybody joining and for allowing me to present today. I do a lot of things at Ash Brokerage, but ultimately I introduce myself the most frequently as just sort of a life insurance nerd. And so forgive me if this sounds a little nerdy, but the purpose of today is really just to educate on what's out there, what might fit best, and how we see really good planners like Cornerstone and Alex at Cornerstone implementing life insurance in a way that makes the most sense for you. And so I'm going to just sort of take this a phase at a time, a product at a time, to really help set the stage. And I'm going to start with the uses of life insurance. And I think this is actually probably the most important thing, because really defining what you want out of your life insurance, what you want, if you kind of play it forward, and that can be a really tough conversation to have, but we encourage people every day to play it forward and to say what happens if, and then to evaluate, if the what happens, what do I want to happen? Who do I want to know that I really care about them? Who do I want to, help them live fuller, richer lives? And so personally, we see a lot of folks protecting their income. And so I think of my situation when I think of survivor income. So I am the sole income earner in my household, and I have a wife and 3 young children. I know that if I should get hit by the proverbial bus tomorrow, heaven forbid, my wife might be happy, but ultimately I know that there's a life insurance policy in place to make sure that they don't have to undergo any significant lifestyle changes, that we don't have a lot of debt, but debt repayment would be a part of that. And then for higher net worth families, estate liquidity, legacy planning. And then there are also some opportunities to accumulate funds for retirement on a tax advantage basis. Then we flip over to business uses. If you happen to own a business, buy-sell funding is a really key component of life insurance. Typically, 2 business partners probably work really well together, but they didn't necessarily sign up for being in business with their business partner's spouse, which is what would happen if you didn't have buy-sell agreement with a mechanism to fund that. And so we can talk more about that, or Alex can share more about that. And then there are a couple other ways that to use life insurance for key employees or things like that if you own a business. But ultimately, we think of life insurance as a way to protect your family, your business, or even a charity that you love. And so with that, Alex, what additional context would you give here in terms of the why behind insurance?
Yeah, no, I think actually that's a great reasoning, or actually the reasons you give as far as insurance go. You want to protect your life, you want to protect an income, you want to protect your assets. The same reason we don't drive our car out on the road without car insurance, the same reason we live in our house with home insurance. We want to make sure that the things that we have protected are done so the right way. And the way you talk about it, I think is perfect, because the thing that I'll say, again, insurance should be used as a planning tool. Whether you're using it as an investment, as part of your investment toolbox, whether you're using it as a purely insurance tool, planning with insurance is very important. So it's really good to hear you say that. And again, that's why we make sure to partner with you and the resources you have, because that planning aspect is what's important.
Yep. And that's a great time to kind of segue from, we start with the why, to say, why do I want to have this? And how do I want it to look? But then you go from why pretty quickly to the what, and you say, okay, well, what types of insurance policies are there? And so generally speaking, there are really two types of policies, and it can get really complicated. And there's a lot of vernacular that's thrown out there. I'm going to try to make it really simple. There are two types of policies. There's term insurance, which is pure death benefit protection. It's super inexpensive typically, and you pay a premium for a defined period of time, typically anywhere from 10 to 20, maybe 30 years. And you have coverage for that 10, 20, or 30-year period. At the end of that 30-year period, it's typically gone. You might have an opportunity to convert it to a permanent policy, but generally speaking, 99% of term policies last for the duration, so 10 years, 15 years, 20 years, and then they're pretty much gone. And so again, I flip to my circumstance. My youngest child is 1, and so I have a 20-year term policy, because I know that when my child is 21, he's most likely going to be pretty close to all the way through college, and my need to support him and my other kids is probably less, and I'll hopefully have saved some money between now and then, hopefully. But then there's permanent insurance, and permanent insurance is this, term insurance is like renting, permanent insurance is owning, right? And there are a lot of different ways to own life insurance. And by own life insurance, I mean permanent life insurance. And there are a lot of bells and whistles. You can use it to provide a death benefit or even a long-term care benefit. If you're thinking, gosh, how am I going to pay for long-term care if I have it? And then that's also how you can accumulate some cash value. And so I'll walk through some different ways to do each of these two things, but I wanted to set the table there.
And one thing to add here, Sam, I'm glad you kind of brought it up or said the term rent. It's almost rent versus own, right? The term insurance, you're renting it for a certain period of time. Permanent, you're owning it. And those of us that are on this call, or those who are our guests on this call, or may see this at a later time, owning insurance, even if it's term, is still a key thing to understand, because too often people rely on workplace plans for their insurance needs. And it's important for those of us who are on this call, especially like you said, Sam, myself included, younger, has a family, but I have my work insurance, but then owning additional insurance on top of that, it's very important, for people who see this later on, because if you, and we'll talk about it down the road, but one thing I wanted to point out on this slide specifically, the right to convert without evidence of insurability, and especially if it's term insurance, you buy it for a long period of time. Who knows what happens throughout your life? And if there's a life event, like you said, that proverbial bust, it doesn't have to be death, but that proverbial bust could keep you from being insurable at a future point down the road. So these are things that are all great to consider, and I'm glad you have that up here, because it's really important when talking about that with individuals.
Totally agree. Totally agree. And it's all about making an informed decision, which is what you get when you work with Alex, when you work with Cornerstone. So, let's get into term insurance. And I laid it out pretty succinctly, I think. But advantages of term insurance is it's super inexpensive, and so I can get a lot of term insurance for a relatively small amount of money every year. One of the most common misconceptions about life insurance is actually that it costs too much. You know, people tend to overestimate the cost of life insurance, sometimes by like 50 or 100%. And so, you know, I have a really significant amount of death benefit for what is essentially $500 a year, $500 a year, so $50 a month. So term insurance is very cheap, but at the end of my 20-year period, I either have to convert to a permanent plan if I bought a quality insurance company, quality policy, or I have to go out and try to get new insurance when I'm 54 years old, which may be a little bit harder than it is today when I'm 34. And so it's a great thing for a point in time. And what is really, really important in my mind, and I am just incredibly passionate about this, is that what's really important is that people get covered, and that people get covered with enough insurance, because you know, if a young mother or young father passes away early, that can be absolutely devastating for a family, certainly emotionally, but certainly financially. And I just have no desire to see that, to see the financial impacts in families that I really care about. So this slide right here is really just to give you a sense for what I mean when I say it's inexpensive. And again, people tend to overestimate the cost of these policies. So a male age 30, 10-year term, $1 million of death benefit. In other words, if a male age 30 passes away in the first 10 years, it costs $27 a month to buy $1 million of death benefit. So really inexpensive. It's a really good way to get the amount of benefit that your family really needs in that really sensitive time. And ultimately having a financial advisor who will walk you through, okay, should I do all term? Should I do a little bit of permanent? How should I structure the term? Is a really important component of this, but just wanted to use this slide just to kind of give you a sense for what I mean when I say it is relatively inexpensive.
Hey, Sam, and one thing too to add on there, you hit on it a little bit on the last slide, and then I think it plays in a part here too. It is cheap, you know, relatively speaking, of course, right? The other thing, what I really want to point out though, and I think you said it, is getting a quality insurance company. Just like everything in life, there's going to be good carriers and then there's poor carriers. The poor carrier might price it really cheap, but if they're not able to pay that claim, what was the point of owning the insurance to begin with? And, you know, clients that I work with, and I know other advisors in our firm talk to, is we get the sheet that you send us, and there's the list of, you know, 20, 30 different carriers and the prices that, you know, they give us. But at the end of the day, we're not just evaluating, you know, maybe that is what you're looking for, the cheapest thing, but from an advisor perspective to our clients and those who may be listening today, we're looking not just at the cost, you know, to a degree, but also figuring out convertibility. Is it a carrier that can pay its claims? Is it going to be around in 10, 20, 30 years? Those are the important things as well.
Yeah, there's a huge spectrum of price versus value. And actually, you know, we're going to get into a case study here, and this is one way to look at this, it's a way to talk about, to take it from sort of concept to actually doing some planning around making this an optimal solution. And so, this is a young, very high income earning family. They earn $350,000, and this is just kind of a sample of the way we might look at this. They already have some assets, but their spouse has a significant income need. They need roughly 60% of their annual income if your client, or, you know, if the individual passes away. They're saving a good bit every year. They're earning a good bit on it, and so we created a model, and we said, okay, you know, as they as the individual continues to work, continues to save, gets closer to retirement, their need is this light blue line or this dotted blue line. And you'll have to forgive me. I'm kind of a charts guy. And so if you don't like charts, I apologize. But the dotted blue line shows you what the need looks like over time. And just like you might expect, as you get closer to retirement, typically your need for insurance goes down because you've saved more, you have fewer working years left. And, you know, a lot of planners would say, well, gosh, you need $3.5 million today. And so let's just buy $3.5 million of 20-year term. And so that would be the orange line. And you look, when you get into your 60s, you'd look and say, this is great, but I'm like way over-insured, right? I have too much insurance. And so a good advisor will say, instead of doing that, which 20-year term costs more than 10 years and 15 years, instead of doing that, let's layer a 10-year term, a 15-year term, and a 20-year term so that your insurance coverage matches the gray line, which goes down a little bit as things change. You still have choices, you still have flexibility, but you save 20 grand in your total term insurance cost, and you got the coverage that you really needed. So this is the way that we see good planners sort of evaluating how much insurance should my client have and how much insurance should they have, not just today for however long, but like in different phases of life. So I want to get into this idea of permanent insurance. And I think I said rent versus buy earlier. I meant rent versus own. That's the phrase. But permanent insurance is the idea of owning, right? It's the idea of having insurance that you're going to keep for the rest of your life. And generally speaking, there are two different types of permanent insurance. And there are one thing that can happen when you're looking at insurance is it can get really confusing. I'm going to try to break it down so that it's really basic. But there are two types of insurance. There's universal life, number one, and then there's whole life, number two. And we'll get into the differences that kind of come with these. Within universal life, there are different subsets. But ultimately, a lot of folks view universal life kind of like term insurance for life. You might accumulate some cash value, but typically speaking, it's a level death benefit. What you hope is a level premium for the rest of your life, so that your family ultimately gets a death benefit. And so, universal life says, look, if it's XYZ insurance company, they're going to take your premium. You pay each premium. They're going to take some administrative expenses. They're going to cover what they would call cost of insurance, which would be the amount of money they need to set aside to provide insurance for you. And then the rest of your money goes into this investment account. And this investment account it has three different flavors. You can choose what's called a fixed investment account, which is basically the insurance company invests their money in a bunch of bonds and mortgages and things that earn interest rates. And so they say, well, okay, we'll credit you 4%. And we think we can credit you 4% forever. Index says, you know what, we're going to credit you whatever the S&P 500 does, but we're going to cap the upside at 10% because we can't give you 20 or 30% if the market goes way up. But we're not going to give you any of the downside. So if the market's negative 50 or negative 100, you're going to get zero in that year. So you're not going to lose money from the market. You'll still have your expenses coming out. Variable is a lot like a 401k, where you get a menu of investment options and you choose the investments. And so variable is like choose your own adventure, where you get this menu of investment accounts. It's usually 50 or 60, and you and your advisor can choose how to invest those dollars. Here's sort of a brief description. And Alex, I'd like to get kind of some input from you as to how you guys view this. Ultimately, this is a risk-reward spectrum. The fixed side is kind of like super low risk. Index is a little bit of risk, and variable can be a ton of risk. You can lose all your money, but then you can get, some really significant upside, and you can also be on a roller coaster like everybody's been on in 2020.
Yeah, I'm happy to definitely go through this, because for our clients, seeing a chart like this is really probably similar to when they think about how their accounts are invested with us, from the retirement accounts. Like you said, the 401k being the fully variable. But, for our clients who are on here, if you think about fixed, really we're thinking fixed income, we're thinking cash alternative. We're not going to make a lot with it. And that's really where, the cost, right? So that premium, you're paying the higher premium because you're paying all that cost for the most part. It's the burden's on you. Flip to the full variable side, the burden can be put onto the market to try and, earn those funds. So that way, hopefully the cost to you, the burden to you is lesser at that point. And then you said the index, which index, really kind of being a little bit of a blend there. Like you said, we're not going to get the full upside. So if the market, like this year, if we went through the downside, then the upside, you may not be taking in all those losses, but then depending on when your index period starts, you may not be capturing all the upside with the way that this particular year recovered on the back end as well. So there's definitely gives and takes, and I'm really happy to see this chart specifically because, again, the expected average investment return, I think that's the key thing for people to look at here. Fixed, you're never going to make too much. There's great companies that have really good rates that they pay out. They can pay some strong ones. When you look at net of fees, of course, that's where that expected return. The indexed average return, again, middle of the road. You think that 50-50 from an investment account perspective, if you were to relate it back to, how we would talk about it in the investment only world. And then variable, again, you want to take the risk. You got to be prepared for the ups and the downs, and there's definitely planning involved with that to make sure that you can meet those future needs. So, great chart that you put up here, Sam. Like you said, you're a chart. You like charts. I do too, and I think this is a good one for people to look at or to reference back to in the future as well.
Yep, and those are great points, Alex. And so. I just want to go through a really quick example. This is what we would call a fixed universal life. So it's based on a stated interest rate. And the way universal life, so you see that dotted blue line at the top, that's that level death benefit. And so this is a little bit like term insurance all the way for life. The orange line is kind of a life expectancy. Obviously, we hope everybody lives well beyond that. And frankly, people may. But this policy requires about $9,000 a year in annual premium. And so, it's like, gosh, that's a ton of money. And to which I would say, scale it to whatever would fit. So if you say, well, gosh, 9,000 is a ton of money, but 3,000 is not that, is doable. That's $300,000 or $350,000 of death benefit. But ultimately, what this gets you is, and I encourage people to think about it this way, if you cash the policy in down the road, you're going to get some cash value, but it's not going to be a great deal. If you hold on to this policy and truly set this aside for your family, and so in other words, you take the $9,000, you invest it in this life insurance policy, and then at age 85, you pass away and you give this to your family. A lot of people think 9,000 is an expense, but I actually think that's more of like a reallocation, because the $9,000 a year to generate $1 million at age 85 would have to be invested at a 5.74% investment return. It's called internal rate of return. So that is the return on those premiums if you pass away at age 85, which is a really compelling return because that's net of fees, it's net of commissions, it's net of expenses, and it's net of taxes. And so that can be a really compelling value proposition when you're thinking, gosh, I'd really like to make sure I pass on something significant to my kids, to my grandkids, or to a charity, or to whomever, nieces and nephews. And so we see this as a great tool to protect in the short term, but also to provide good long-term value.
Yeah, and, from a planning standpoint, Sam, this is a good way to look at it. One, you talked about legacy planning. So if you want to make sure that from a legacy standpoint, you're leaving something to your heirs. As we continue to see, the landscape of tax law change down the road as well, setting aside, death benefit, purely for the fact of handling estate, issues. And then also, let's say it's an IRA account that somebody's inheriting, down the road. Depending on what the IRS law is at that time, we just went through a change where you had a lifetime withdrawal rate. Now you have to take it out over 10 years. Depending on if you are a high income earner, you did a great job of saving, you have a couple $1 million saved up in an IRA and you pass away. Now all of a sudden your heirs are left with this tax burden. Let's say that $2 million account, over a 10-year period is going to be at least 30 to 40% less, just depending on the tax rates and what they are at that time. So, it's one thing to think about just purely from an estate planning standpoint, leaving a legacy. But this is a great way for, clients to really plan to help their heirs or whoever inherits this or receives the money to be able to manage other expenses aside from just thinking about, what it costs to, unfortunately, have somebody pass away and then manage their estate. So from a planning perspective, this is a great way to make sure that you have some of those things covered as the landscape continues to change.
Absolutely, completely agree. It is a phenomenal planning tool. So with that, I want to take what time we have left here, which is a few minutes, and touch on whole life, because I think whole life can be absolutely fantastic consumer value, especially in the long term, especially when we have a ton of market uncertainty like we've had in the last 6 months. Certainly when you think of the market uncertainty we had 12 years ago in 08, 09. Whole life insurance brings a different value proposition. Basically, you're sort of like overpaying for it, and that's a really negative way to put it, but you're kind of overpaying for a guaranteed policy, and it's guaranteed for the rest of your life. But you're basically paying too much because the insurance company is guaranteeing it, but then the insurance company says, you know what, guaranteed mortality, we see way better mortality experience than the guarantees, and we earn a heck of a lot more in interest. And by the way, this is what's called a mutual insurance company, which means as a policy holder, you actually are an owner in the company. You own the company. It's owned by the policyholders. And so they return dividends. And so you might pay, X in premium, but then you might get 5% of X or 6% of X back in terms of a dividend. And so advantages are this can accumulate a ton of cash value, which can be great for accessing for retirement or for a rainy day. Say you need to make a down payment on a home or a car or something like that. And then the guarantees are fantastic. So here's an example of how whole life might work for the exact same individual. They start off with $1 million death benefit, but the premium instead of $9,000 is $26,000. So it's a huge kind of eye-popping difference. But if you look at the dotted blue line, at life expectancy, that $1 million death benefit has grown to over $2 million, and that's because of all those dividends that have accumulated and added additional insurance. And you could maybe stop paying premiums at that point, or you can maybe start taking some of that cash value out. And ultimately, you look at the return on investment for your death benefit. So again, you pay the $26,000 a year, age 85, the bus happens. Your net investment return is about 4.5%, which is really fantastic. And considering that it's kind of liquid along the way, is super important. The one thing I would say about this is just make sure you're looking at a really high quality carrier, great ratings, great dividend history, and a long track record in this business, because this can be a really incredible value to you. So, and Alex, I don't know what else you'd add to this component of the discussion.
I think you hit a lot of the main things here. Again, owning permanent insurance, and in this case, as we see this line, you illustrate, the cash value building. That's the thing with whole life insurance that is really important to understand. People always think of it like I think you said, costly, right? Expensive. But when you think about how it works for you, again, from a planning perspective, we might sound like we're repetitive, like we might be saying the same thing slide after slide, but really it's because understanding the basics of this, where it's used as a tool, you see that cash, that outlay, right? Those are the things that you want to look for when you're purchasing a product. Again, comparing it back to the term, that term, let's say that yellow or orange dotted line right there is when your term ends. You then have no cash value unless you convert it. There's no more death benefit. Whereas in this permanent case, now we have cash value. Now we have death benefit. Let's use 2020 as an example. We have a bad year. We don't want to touch our investments. All right, let's go borrow some of this money out of the cash value of the whole life policy, so we don't have to, realize a loss in the midst of a massive drawdown of the market. So it's tools like this that enable, planners like myself to be able to help our clients navigate really uncertain market conditions and estate conditions at the same time.
Yeah, I love that example that you used, Alex, of the market took a downturn. So, let's say that 85-year-old is retired and March of 2020 happens and the market pretty much instantly is down 25-30%. And he or she still needs to make a distribution to fund their living expenses. And so you're pulling 20, 30 grand out of your investment portfolio at the absolute worst time possible. And you missed all of the run up that we've had in the last, 6 months since then. And so, having this cash reserve out there that's going to earn a really good rate of return, I think is just absolutely crucial. So, with that, I want to hit on this, and then I think we'll be ready to wrap up. And if you have any questions, feel free to chat them into the chat function of the Zoom here. But riders, and this is really important because one of the ways that life insurance has really differentiated itself over the recent years is that you don't just have to die to access the death benefit. And what I mean is this: there are riders that allow you to accelerate the death benefit, typically dollar for dollar, if you have a long-term care need. And so let's say you need somebody to come in for home health care, and it costs you $5,000 a month. These riders will allow you tax-free to accelerate the death benefit, dollar for dollar, to pay that provider, or in some cases, you can actually pay a loved one, depending on the policy of the product. And so those are really, really popular. A lot of folks say, you know what, I'd love to give my kids $500,000 or $250,000, but you know what? One of the things that could kind of interrupt that for me is if I need a lot of money for long-term care when I'm in my 80s. And so you say, I'm going to buy this policy and it's going to provide $500,000 of death benefit, but I can access all of it if I need it for long-term care, and it's all tax-free because I know that's going to benefit my kids, because my kids might be my caretaker if I don't have those funds. And so those are really important and really impactful, and we've seen those become really popular. There are disability riders. So there are riders that'll waive your premium if you become disabled or continue to pay your premium. So, you say you have that $26,000 whole life premium, and for whatever reason you're disabled, you can't do your job. It may be that rider would pay the $26,000 premium into your policy for you. So it'll help you in the event that you have that issue. There are some other features as well, but those are the really two popular ones.
And before we move past the slide, everybody that sees this, this right here is a sheet, basically that includes almost all the reasons you would, or a lot of reasons you think about insurance aside from just, put $1 in, get $3 out whenever you pass away or whoever it passes to. Everybody talks about being insurance poor, or, it's kind of a thing, right? If you pay all these insurance premiums, we're asking you to pay life insurance premium, we're asking you to pay disability insurance premium. But realistically, if cost becomes a matter of issue, now we look at ways, how can we combine policies into one product, right? So, Sam, that's a great example, long-term care. Everybody in this firm, we talk about long-term care probably just as much, if not more, than life insurance, because as we know, the cost of long-term care continues to rise. The number of providers, especially for traditional long-term care, continues to get smaller. We want to focus on ways that we can return value, and these products and these riders are ways that value can be returned to our clients, aside from just them passing away and then the death benefit goes to the heirs. So this right here, anybody that watches this, or those of us that are still with us today, this is a great example of insurance and the many tools and uses for it, for sure.
Absolutely. So with that, I want to wrap up just with a comment on taxes. And this is actually probably going to be super relevant. It's relevant today, but it's going to be super relevant, I think, in the coming years. Life insurance is still one of those assets that gets a bunch of tax goodies. And we want to keep it that way, partially because it's our industry, but also partially mostly because we see it as a huge societal good. And so when you think about life insurance, so premiums are typically not tax deductible, but most everything beyond that point can be tax deferred or even tax free. And so death benefits are tax free. Long-term care riders are tax free. When you build up a whole bunch of value inside your policy, you can borrow against it tax-free, or even take withdrawals up to your cost basis tax-free. That's very unlike most other assets. And so, so life insurance, those tax goodies are really, really important. And they could become even more important if we come to a place where tax rates start to go up. I think, and this is not a political statement, but I think there are a number of folks that will increase taxes for certain subsets of the population. Having dollars inside of a life insurance policy kind of gives them a hedge against rising taxes. And so for individuals, the tax benefits are really significant. For businesses, they can be really significant as well. One of the most common questions I get is, hey, can I deduct the premiums as a business expense? And the answer to that, unfortunately, is no. But again, all the values you accumulate inside the policy are tax deferred, can be borrowed against tax free. And so a lot of business owners will have a really significant chunk of money inside of a cash value life insurance kind of for that rainy day. And they know it's maybe a better yield than cash, or just kind of a safer investment. And so, so we see a lot of clients that really benefit from those tax goodies. So with that, Alex, yeah, go ahead.
Yeah. No, yeah, I was just going to say, even talking from the business perspective, and I know that, hopefully we'll have another webinar here, over the next weeks and months that, talks on business. But it's a great way to retain, top talent, key employees as well. So if you think about, small business owners, if there's any on this call or any that see this later, think about the ways that you want to provide value and benefit to those who work for you, especially if they're a key employee. Owning or, assisting with them in owning insurance, right? So it's just another tool, giving them a 401k plan, giving them, health insurance coverage, giving them a life insurance policy. Again, we talked about term insurance and how, a lot of people utilize their company insurance as the main source of their insurance, unfortunately. But it is still a way to retain top employees, especially if you are a small business owner and you're wanting to obviously give a benefit to them. Just wrapping up again, if anybody does have any questions, please go ahead and send them in. We'll, jump here to kind of the exit slide and wait around a minute. But, just to kind of sum things up and wrap up our call today, Again, thank you, Sam, for joining us and taking the time to educate everybody both on the basics of life insurance. Again, the focus was term insurance, whole life insurance. What are the differences? There's a range of planning ideas and uses for insurance. And our goal again today was just to really skim the water with, what we can talk about. From now we will probably focus on, maybe a webinar on estate uses for individuals, into other individual tactics and ways that you can utilize life insurance. And then again, from business perspective, how you can use it from an exit planning strategy, how you can use it day to day, again, retaining top employees. If there's no other questions or anybody else that wants to chime in, today, is there any last things you want to add, Sam, before we go ahead and say goodbye today?
No, just thank you for the time today, and I'd encourage you to reach out to these guys. Ultimately, insurance is one of those things that absolutely has to be connected to a plan. And so, Alex, I really do appreciate you having us. Thank you.
Yeah, well, thank you. Thank you, Ash, for again being a partner. And everybody on the call, thank you. Have a good evening, and we will see you again on another webinar.